The question I'm hearing the most from people is what's going to happen when central banks stop their printing or even slow down their printing, and what's going to happen when markets are allowed to discover the real price for things. And this is the stock market, the bond market, the currencies market, and the physical asset market. But what's going to happen basically when all this manipulation and manufactured movement goes away or starts to change? Because people need to understand what that's going to be, given that since the bottom of 2009, we've been in a very manufactured, central bank driven economy and market. And so that's what I want to discuss with you in this week's market situation report. Really, my big thoughts this week is is or was, are central banks losing control? Did they lose control? Did Japan lose control of their markets? And in hindsight, we'll see that it clearly happened in the last 25 trading days, or has it not happened yet? And really, what might happen if QE is turned off? I'm having fun with the word if because eventually it will, um, but probably not. Probably much. We'll have it much longer than we think we'll have it. And I want to know who's going to be hardest hit or what assets are going to be hardest hit. And then finally, I want to understand where the money might be flowing so we can get there before all the money pushes into it. So let's take a look at some things that I've pulled together, some research I've pulled together over the last 25 days to give us a bit of an insight to what may happen. So something on May 22nd happened, and basically a word called taper was introduced to the world. And basically it was the idea that the central bank of the US may start to taper the amount of money they print to buy treasuries and mortgage-backed securities. Since the 22nd, what I wanted to do is see what has happened in the markets. And the first thing I looked at is municipal bonds because most people consider municipal bonds to be pretty risk averse, low volatility. It's the place you want to put your money if you're 60, 70, 80 years old because it's going to be there. But just notice what happened here. Municipal bonds got crushed. They went from about 110 down to 107. And you may say, that's not a lot. But when you lose 3% and you're only making 4% for the year and you lose 3% in 1 month, that's a significant move. People clearly moved out of municipal bonds thinking that the Fed may start pulling back on its money printing. The other thing I wanted to look at was what happened to mortgage rates. Real estate is absolutely skyrocketing here in Silicon Valley and Manhattan and other places around the country. Not evenly, but it's happening. And so what's going to happen if rates go up? Well, as soon as May 22nd happened, which is the vertical blue line on this screen, you can see that mortgage rates, this is a 30-year fully amortized mortgage, the average of it totally skyrocketed up. That is not a good sign, because that's going to make housing more expensive. And the big thing that's been pushing housing is really, the zero interest rate policy from the Fed. So housing is going to be hit. The next thing I wanted to look at was just kind of some major assets of the world. So I wanted to look at what happened to the S&P, the US dollar, bonds in the US, commodities, and gold. And if you can see here, we have the blue vertical line, and stocks went down. Not a lot, but stocks did move down. Not as bad as the dollar. Look at the dollar really moved down almost 5%. So stocks were hit, but not as bad as the US dollar. Also, bonds went down too. People moved out of bonds. This is where I think it gets a little interesting. Commodities basically stayed flat. They're actually up a teeny tiny bit from the 22nd, but interesting that they didn't fall. They kind of stayed flat and they actually went up a little teeny tiny bit. It's hard to tell on the screen, but they did. And the other thing I found interesting was gold did not go down, and it went up a little bit. Not much, but it did go up a little bit. So the next thing I wanted to look at was all major stock markets around the world. Stock markets in the US, stock markets in Europe, in Africa, in Asia, and Latin America. And this is what we saw. The US, still the best looking horse in the glue factory. It fell, but not that much. Second best looking was Europe. It fell, but actually not that bad. And then look here, Africa fell hard. Asia fell even hard, and Latin America got crushed. So much for the BRIC countries and a place to be safe or to find some good leverage. Latin America got crushed. Asia got taken out. Africa, interesting enough, didn't fall as bad as those two. And then one of the last places I want to look was actually currencies. And so I looked at the US dollar, the euro, the yen, and gold. Now, I know gold is not one of the larger currencies in the world. In fact, it's one of the smaller. But the reason I have it on here is because the world is fastly moving in the direction of more and more gold and not less. And as the price of gold falls, the demand goes up. There is a very clear correlated divergence going on. As the price falls, the demand goes up. So let's just look at this quickly. The dollar fell, like I told you before. The euro went up. That was interesting. People moved into the euro when people thought that Ben Bernanke was going to start pulling back on the money printing. I thought that was very interesting. Look at this too. The yen went up. That's pretty impressive. People moved back into the yen. And then lastly, people moved into gold a little bit based on the price. So what happened with currency? People moved into gold, people moved into yen, and people moved into euro. Very interesting, but they moved out of the dollar. So where does this all lead? Basically, it leads to, what are you going to do when you have to invest without central banks? And I touched on it a little bit, and that's only been 25 days from May 22nd, but it gives us some insight. So next Wednesday, I think it's the 19th, next Wednesday, I'm going to spend a whole bunch of time looking in more detail what is moving, where money is flowing, where's money flowing out of, for when central bank printing slows down. It's not going to stop, but it definitely may slow down, and we got that hint about 25 days ago. So I want to know what assets will be hit the hardest. I want to know where the money is going to flow the most, and I really want to know how the best investors are going to protect their assets. So we're going to go over those three questions. We're going to answer those three questions next Wednesday, June 19th. Nothing to sign up for on this market situation report, but you'll probably get an email, and you may want to sign up for that conversation the 19th of June. I hope you guys have a great weekend. You take care, and I'll speak to you then.